Something is building underneath this market. Not in the headlines, not in the daily price moves. Underneath, in the plumbing. In the places where the real structural forces accumulate quietly before they become impossible to ignore. Right now, two completely separate forces are moving toward the same asset simultaneously. One is monetary, one is industrial. They have different origins, different drivers, different timelines, and silver stands directly at the point where they meet. Excited. When two forces like this converge on a single asset that is already running a structural deficit for 4 consecutive years, the result is not subtle. History does not warn people twice about moments like this. This video is the warning. The Federal Reserve is inside a 2-day meeting right now. Most people watching this are asking the wrong question about it. Curious, they are asking when the Fed will cut rates, treating it like a countdown. Exhales. Waiting for the announcement as the signal to act. That is a costly mistake. The real signal is never in the announcement. It is in the language before the announcement, the tone, the phrasing, what gets left out as much as what gets said. At the last meeting, the Fed held rates steady. What mattered was not the decision. It was 2 words in the statement that followed. Somewhat elevated. That phrase, somewhat elevated, is not casual language. It signals that the Fed is not ready to move. That the restrictive posture, the high-rate environment squeezing borrowing, slowing spending, reshaping asset valuations is still firmly in place. The most recent consumer inflation data confirmed it. Annual headline inflation still running in the mid-2s, not collapsing, not surging, sitting there, persistent, stubborn. The kind of number that keeps a central bank cautious. And here is what every serious observer understands about restrictive monetary cycles. They do not last forever. At some point, whether driven by economic slowdown, labor market deterioration, or the weight of sustained pressure on growth, the Fed will shift, the language will soften, the pivot will begin. And when that moment arrives, capital moves fast. Gold moves first. It always does. It is the simpler story, the cleaner monetary hedge. But silver follows. And then it does something gold cannot do. It accelerates, because silver carries a second force with it that gold does not have. Think of 2 rivers flowing from different mountains, each one carrying its own current, its own momentum, separately, powerful. When they meet at the same valley floor, the water does not simply add together, it transforms. Silver is standing at that valley floor right now. The first river is monetary, interest rates, inflation, Fed policy, dollar strength, the emotional weather system that has always shaped hard assets. When rates are high and inflation is cooling, pressure on gold increases. Investors can earn real returns elsewhere. The urgency to hold a non-yielding asset fades. But when inflation stays stubborn, when the Fed is boxed in, when cutting feels premature and holding feels painful, serious capital starts asking different questions. Not should I hold gold, how much, and when, and what about silver? The second river is industrial, and the second river is the one that changes everything. Unlike monetary policy, which shifts on decisions made in meeting rooms, industrial demand does not wait for announcements. It does not pause for Fed statements. It does not care about rate dot plots or press conference language. It moves because the physical world demands it. Pick up any smartphone. Inside it, silver is working. Put a solar panel on a rooftop, power a data center running artificial intelligence, build an electric vehicle, wire a military communication system. Silver is there, not as decoration, not as a symbol. As a functioning, irreplaceable component of modern civilization, solar installations are being built today, tomorrow, and every day after that, with or without a Fed rate cut. Data centers powering artificial intelligence are expanding at a pace that would have seemed impossible a decade ago. Grid infrastructure modernization is consuming silver across every major economy simultaneously. Advanced defense systems are accelerating, not slowing, during periods of geopolitical uncertainty. These are not future projections. These are active, funded, ongoing industrial programs running simultaneously, all drawing from the same constrained global supply. Global industrial demand for silver reached a fresh record in the most recent full annual survey, approximately 680 million ounces consumed by industry alone, not by investors, not by jewelers, by factories, manufacturers, technology producers, energy developers. Against that industrial demand, supply has not kept pace. The global silver market has been running a structural deficit for 4 consecutive years. The world is consuming more silver than it produces, year after year after year, and the forecast for the coming year points toward a 5th consecutive deficit. Consider what that progression means. 1 deficit year, managed. Stockpiles absorb the gap. 2 years, analysts note it. Reports get written. 3 years, questions are raised. 4 years running into a projected 5th is no longer noise. It is a pattern, a structural one. The kind that does not resolve quietly on its own. And here is what the mainstream coverage consistently misses. The structural deficit does not announce itself with a flashing light. It shows up in the plumbing, it shows up in lease rates, the cost of borrowing physical silver for short periods. When those rates spike unexpectedly, available supply is tighter than headline numbers suggest. It shows up in spreads, the gap between spot prices and futures prices. Unusual spread behavior tells sophisticated traders that something beneath the surface is not behaving normally. It shows up in industrial buyer behavior. When manufacturers stop waiting for price dips and start placing longer forward contracts, that behavioral change is itself a signal. Quiet, but real. And it shows up in government classification decisions. Because in the middle of all of this, the United States government added silver to the final U.S. critical minerals list. Not proposed, not suggested, finalized. Listed alongside materials considered essential to the economy and national security. Once a material enters that category, the entities that need it stop thinking like investors. They stop asking, should I wait for a better price? They start asking, how do I secure supply before someone else does? That is a completely different mindset, and that mindset is already active. There is an image worth holding. Not a burst pipe, not a dramatic explosion, a slow, steady leak hidden behind a wall. Day 1, no visible damage. Month 1, the wall looks perfectly fine, but inside, pressure is building. The structure is quietly weakening. And then one morning, without theatrical warning, the ceiling comes down. Not because of anything that happened that morning, because of everything that had been building silently for months before. This is the picture the silver market is painting right now. Now the argument that makes silver's current position structurally unique, the double pull. If the Fed eases monetary conditions, silver benefits from the monetary side. Dollar weakens. Real rates fall. Non-yielding hard assets reprice. Gold moves first. Silver follows and then accelerates beyond gold because it carries the second force with it. If industrial demand continues its current trajectory regardless of what the Fed does, silver benefits from the supply pressure side. 5 consecutive deficit years. Critical minerals designation. Industrial consumption across irreplaceable sectors growing simultaneously. And if both happen at the same time, a market already running a structural deficit for 5 consecutive years, carrying a national security classification, embedded in the infrastructure of modern civilization, has to respond. Not because of speculation, not because of social media momentum, not because any analyst recommended it, because supply and demand, the oldest, most honest force in all of economics, demands it. This is the convergence. 2 rivers meeting at the same valley floor. The monetary force building as the Fed approaches its inevitable pivot. The industrial force compounding as the structural deficit enters its 5th consecutive year. Silver at the intersection of both. The bear case deserves full precision alongside the structural argument, because intellectual honesty requires it. And because the strongest case for silver does not need to avoid the counter-arguments. Not every unusual market movement is evidence of structural design. Markets can be thin. Liquidity can vanish without warning. Algorithms can amplify moves that have entirely ordinary origins. That is real, and it matters. Here is the specific bear case that demands analytical respect right now. The convergence argument is structural and long-term. But the paper price operates on a shorter timeline governed by different mechanics. The dollar is currently above 100 on the DXY. Every dollar of dollar strength creates mechanical downward pressure on every dollar-denominated commodity simultaneously, regardless of structural deficit data, regardless of industrial demand trajectories, regardless of critical minerals classifications. If Wednesday's Fed statement surprises to the hawkish side, if the dot plot eliminates projected cuts or any FOMC member advocates a potential rate increase, the dollar strengthens further and paper silver moves lower, not because the structural case has weakened, because the paper market is operating on a different timeline to the physical market. The COMEX delivery stress is acute right now, but exchanges under stress have tools. Emergency cash settlements, delivery deferrals, position limits. The delivery crisis can be managed temporarily without the paper price being forced to reflect physical reality immediately. And if the Shanghai premium continues compressing toward zero, the physical floor that has supported silver for months weakens further before it rebuilds. The structural case is the strongest it has been in 4 years. That does not mean the paper price cannot move significantly lower before physical reality forces the resolution. Understand the difference between the structural thesis and the short-term paper price. Size your position accordingly. Do not confuse conviction in the long-term argument with certainty about short-term price action. Here is what to watch as this convergence develops. Watch Fed language Wednesday, not the decision. Specifically watch for 3 phrases: supply shock, transitory inflation, liquidity conditions, Any of those phrases in the statement signals the Fed is beginning to acknowledge that current inflation is war-driven, not demand-driven. That acknowledgement opens the rate cut pathway. The rate cut pathway is the trigger for the monetary river to accelerate towards silver. Watch industrial forward contract behavior monthly. When large industrial users, solar manufacturers, EV producers, defense contractors, stop buying at spot and start placing multi-month forward contracts, that behavioral shift is the earliest available signal that the security of supply mindset has activated. That mindset change precedes the price move. Watch the silver lease rate. When the cost of borrowing physical silver for short periods spikes unexpectedly, available supply is tighter than registered inventory figures suggest. The lease rate is the canary in the physical supply mine. Watch the gold to silver ratio. At 61:1 today, the ratio is significantly above its long-term historical average of 47:1. The compression from 61 toward 47 does not happen gradually once it begins. It accelerates. The ratio compressing below 58 is the first confirmation that the two rivers have begun merging. Watch the U.S. critical minerals policy developments. Once a material is classified as a national security asset, procurement behavior changes. Government-backed strategic reserve building, allied nation coordination, industrial allocation priority. Any of those policy developments represents the security of supply mindset becoming institutionalized. That is the moment the industrial river becomes a permanent structural floor rather than a cyclical demand signal. Here is where the silver market stands. 4 consecutive years of structural deficit moving toward a fifth. Critical minerals designation activating security of supply procurement psychology. 680 million ounces of annual industrial demand growing across irreplaceable sectors simultaneously. The Fed holding at restrictive rates while inflation stays stubborn, building the pressure that precedes every monetary pivot, the monetary force and the industrial force moving toward the same asset at the same time. And this week, the most acute COMEX delivery stress in modern market history. 74.38 million ounces delivered against 86.13 million registered with demand still outstanding. The Fed meeting underway. PPI tomorrow morning. The rate decision Wednesday afternoon. The convergence OG John has been describing for months is not a future event. It is happening in the data of this specific week. The structural argument does not need the acute data to be valid. The acute data does not need the structural argument to be significant. But when both are present simultaneously, the case for silver is not built on hope or hype. It is built on the oldest and most honest force in economics, supply and demand. And supply and demand right now, across the physical market, the futures market, the industrial market, and the monetary market simultaneously, are all pointing in the same direction. Verify everything in this video. The U.S. Critical Minerals List is a publicly available government document. Silver Institute annual supply and demand data is published and freely accessible. COMEX delivery notices and registered inventory are updated daily on the public record. Fed statements are published in full at 2 p.m. Eastern Wednesday. The gold to silver ratio is a live number on any financial data terminal. The data is public. The convergence is documented. The only requirement is the discipline to read the structural forces as clearly as you read the daily price. Invest with logic, not hype. Market Crux. Signing off.